Good afternoon, my name is Besarion Beriashvili, and today I'll be discussing financial ratio analysis. Our objective: choose two different sectors of 5 firms from each sector, use financial ratios to analyze data: liquidity, profitability, asset efficiency, market value, and market to book. Goal: identify the best company out of the 10. First sector: cable and satellite, cable and video services. DirecTV, Comcast, Dish Networks, General Communications, and EchoStar are our first 5 companies. Description: this is a description of what the companies do, but we're going to get more into ratio analysis, and I'll talk about what they do. You can freeze the video if you like to see the mission statement and slogan. But this is the market capitalization for each 5 firms, Comcast being the top 64% out of the whole pie, DirecTV and Dish Networks coming followed by EchoStar. Our first ratio we're going to use is quick ratio, the ability for the company to pay for its current liability using its current assets. Now this number we want high as possible. Immediately we notice EchoStar is a top choice, being 3.8 beneath the 2013s. When we put it in percent form, it helped us decide on our second choice because we see a nice movement throughout the years, like we see in Dish Networks, because 2011 to 2012, 2013, it's made a quite nice jump, moving above everyone else and making a higher percent change. So we're going to choose the Dish Networks as our second choice. First will be our EchoStar. The next ratio was total debt to total asset. Now we want this number as low as possible. We obviously notice EchoStar and Comcast switching off a couple of times, and they might be switching off in the future, maybe 2014. But we're gonna say Comcast is number 1, EchoStar is number 2 as our choices. Now we're gonna use ROE decomposition, a dew point analysis, to further see how well the company is performing relative to how much equity. Return on their equity, basically. We're going to begin by tax burden. Tax burden, we can't do too much about that, but we do not want so much volatility. We don't want this uncertainty of how, if they're paying the state level taxes to federal level taxes. So we're going to automatically knock out EchoStar. They have such a high volatility. So we're going to, these 3 aren't too bad. Comcast, Dish Network, DirecTV, they're not too bad. So we're going to keep these 3 as our choices. They're relatively nice. Again, our interest rate burden, this also, we don't want such a volatility, but all of them are pretty nice. They're able to pay for their interest, and general community, we'll knock them out because they're way beyond the 3. Again, we're going to keep Comcast, DirecTV, and Dish Networks. Those 3, again, moving on to their further through. Our decomposition of operation margin, what's left over after paying their expenses. We automatically notice Comcast, such a high operation margin relative to everyone else. So we're going to choose operation margin from Comcast as our first choice. And our second choice, we did put in percent form the change, is it increasing throughout, and we noticed that DirecTV has been doing relatively well, except the 2013, yeah, they had 5% decrease, but if you look at everyone else, 5% wasn't too bad. So DirecTV will be our second choice, Comcast the first choice. Now, asset turnovers, this is also management's, this is what we look at, what the managers are doing. This is management's portion of the company. Immediately we notice Comcast having such a low asset turnover ratio compared with operation margin. So they're making so much operation margin out of such a little bit of assets that are going out and coming in. 4.0. So we're gonna put them as number 1, and we're gonna knock out the Dish Networks and DirecTV. They have really high asset turnover. We're also gonna keep General Communications because they have 0.6. They have pretty low asset turnover for its operation margin. 13, 12 is pretty good operation margin for its asset turnover. So we're going to keep Comcast and General Communication. Move on to leverage. How much higher equity multiplier indicates of the larger portion of the assets are being financed through debt. So higher, the more being financed through debt. Uh, we can knock out general communications and Dish Networks has only posted one in 2013. This data was pulled from Bloomberg. Um, DirecTV again pretty high. They don't seem to want to show their previous years or after years. So we're gonna knock those three out, and it's gonna leave us with EchoStar and Comcast. EchoStar having the lowest, but we still like Comcast from its previous data. So we're gonna put Comcast as number one. Now we're moving on to economic value added, value created in excess after paying their investors. So we're gonna see who has the highest, and we notice Comcast. Wow. We're gonna put Comcast number one and DirecTV number two because this is millions and that's 2.3 billion and that's 2.4 billion. We like that relative to everyone else. This negative 1.6 million. That's really out of the world. Price to book. The price on the stock relative to the book. We notice Dish Network and DirecTV have pretty high. DirecTV, they had it from 2009. They didn't show the recent ones, so we're gonna we can actually knock them out. Dish Network, we're gonna keep. They have pretty high. Their price is the price is pretty high for what the book is showing. So maybe they're expecting better returns on their. One, two things. Either the market believes the asset value is overstated, or the company is earning very poor returns on its assets. It could be either one. Price to earnings, higher the number, future expectations for the company is supposed to be better. So Dish Networks, pretty high future expectations from the investors. Price to equity. EchoStar also having a high price to book, but unfortunately we don't want too high because I mean it's good, but it's not what the equity is showing. It's what it's been priced. It could be overpurchased and just driven the price up. But I like Comcast, so we're going to keep Comcast. Overall, we've noticed that Comcast had the best numbers, so we're going to choose Comcast as our winner from the five firms. We're going to move to the next section, electric equipment and AC heating. This is our second industry. Linux, Aon, Ingersoll, Dove Corporation, and LSB Industries. These are the companies we're going to look at. This is a description of what each company is located and what they do throughout the years. Mission statement, slogan. You can freeze the video if you want to view these data more. Read through them. Market cap. We notice Ingersoll as the highest market cap, followed by Dove Corporation, LSB, Linux, and Aon. Again, moving to liquidity, current liabilities to current assets. With the current assets, can they pay their current liabilities? So higher, the better for these numbers. You see that Aon has a pretty good. They moved up 2012, 2000. They moved above everyone else. But when we put it in percent form, we see that actually LSB Industries aren't doing too bad. They're keeping up. They're doing pretty well. We're gonna put them as number two. They're not too far difference between the two. We're gonna move to our R&D composition. Given by tax burden, volatility is what I'm gonna focus on. Knock out Ingersoll Corporation. They seem to be changing. They might have some problems. Again, we never know. So we don't like uncertainty. We're gonna move on. Dope corporations, they're not bad. They have relatively pretty decent. Aon has a pretty decent as well. So we're gonna keep those two. Keep those numbers. They're not bad. Then again, the interest rate burden. Aon seems to be doing it. So we're gonna choose Aon as number one here. And then the second one's gonna be Linux, because Linux is not too much. They're above what they can pay for their interest, so that's definitely good. That's a definitely good sign. If it was one, they'd have absolutely no debt, but they're able to pay them, and it's not below one, so it's good. They're all got good numbers, but we're gonna choose Aon as our first decision on it. And let's move on to operation margin. This is again management's position into what they're doing in the company. And we noticed Aon as number one choice, so we're going to choose them as number one. And we put in percent firm like we did previous firms. And we noticed that actually Dove Corporation is not bad. 1% in 2013 decrease. So we're going to choose them as number two. And now we're going to move on to asset turnover. We're going to also tie this with operation margin because those two seem to go hand in hand. And we noticed that actually Dove Corporation isn't too bad. They have a low asset turnover, pretty decent operation margin from what we saw. But we're going to keep LSB Industries tied in with it. They're pretty good. We're going to keep those two together. So we're going to keep Dove as number one choice. Next, we move on to leverage ratio. And now we notice, relative to everybody else, all the other companies, Dove Corporation seems to have the best decision, they're not too high. Again, they're not too low. We're gonna keep LSB Industries in case we see further information that comes up that might change the game plan. Now let's move to economic value added and market to book ratio and ROE. Economic value added for Dove Corporation, we're gonna try to focus on that. 85 million, and Linux 87 million. Unfortunately, previous data shows Linux wasn't doing too good. We haven't chosen them as our choices so much. So, Dove Corporation, we're gonna choose them, and then second gonna be Linux. Let's move to market to book. And Dove Corporation, it's not too expectations not too far apart from the books. So Dove we're gonna keep. Linux, so maybe it might be a little bit too high, but we're gonna keep Dove Corporations as our choice for this. It's not too high, it's not too low. It's right there. And future expectations, what the market expects in the future from these companies, they're all relatively similar to each other. So it's kind of difficult to decide on this. They're about that level that they need to be. They're not over expected, except around above its stock price. So we can say that there might be future expectations on that might be a little bit high. But Dove Corporations, we're going to choose them. So out of these companies, we chose Dove Corporation as our second competitor with Comcast because it's economic value and operation margin. But if we compare Comcast and Dove Corporation, we notice that operation margin for Dove Corporation was 15.51, and operation margin from Comcast is 20, with asset turnover 4.4, and for Dove Corporation's 0.82. Yes, leverage was high for Comcast, but higher by one. The Dove Corporation having 2.07 the leverage, but again, economic value for Comcast is way beyond the 85 million. I mean, 2.4 billion. You can't compare the two with the stock price. I mean, if I'm gonna pay $75 for a share rather than 56, I would much rather pay 56 and see the company have more left over after paying its investors. So therefore, we chose Comcast as our number one choice, and that's my conclusion of financial analysis, of financial ratio analysis of the company. And thank you for watching.